Next, we're going to go through the accounting cycle step by step by preparing actual transactions for a company for the month of July. We have our information here. This spreadsheet is available in the Week 1 module. It's called Accounting Cycle Practice in Excel. You can follow along and record this information yourself to practice. This will help you. These Excel exercises that are provided weekly will help prepare you for the homework assignments and will give you a nice resource for when you are working on homework. So you can see that we have the directions here are to go through the 8 steps in the accounting cycle. We have the information and our chart of accounts. We are going to start with journal entries. So we have these different transactions and we need to complete a journal entry for each transaction, post it to our accounts, and then prepare an unadjusted trial balance for the month of July. So we'll just go through these one by one. So on July 1st, we invested $30,000 in cash and $150,000 worth of buildings in the company in exchange for stock. So we received cash and a building, and the owner received stock in exchange for the cash and the building. So let's walk through our first journal entry together. The date is July 1st. We always start with our debits. First, we have cash, which is an asset. Since cash is increasing, we record it as a debit of $30,000. Next, we have a building. Buildings are also assets, and we are receiving one. That means we increase the building account, which is also a debit of $150,000. Now, to balance this, we record a credit to capital stock or common stock. The credit must equal the total of our debits. So we take $30,000 plus $150,000, which equals $180,000. That's the amount we credit to capital stock. Remember, every journal entry must balance total debits equals total credits. Now, one quick Excel tip: instead of using a calculator, you can let Excel do the math for you. In the cell where you want the total, type the equal sign, then select the cells with the amounts you want to add. In this case, the $30,000 and the $150,000. Excel will automatically calculate the sum for you, saving time and reducing errors. In the same way, we record the rest of our transactions. Here we have some different types of expenses, as you can see. You might wonder, why do we always debit these expenses first and then credit them? The reason is that expenses always increase with debits. So when we pay salaries, utility bills, or any other expense, we record them on the debit side. The same logic applies to dividends. Dividends reduce equity, and a decrease in equity is also recorded as a debit. Now, when we use cash to pay off these expenses or dividends, our cash, which is an asset, is decreasing. And remember, a decrease in an asset is recorded as a credit. Okay, now that we've recorded all of our journal entries, the next step is to post them into our T accounts. We'll go through these one by one and transfer them to the T accounts on the next sheet. For our first journal entry, dated July 1st, we divided cash for $30,000. Then also on July 1st, we divided building for $150,000. Finally, to balance the entry, we credited common stock for a total of $180,000. Now, instead of retyping all these amounts manually, here's a helpful Excel tip. In the T account sheet, simply type the equal sign in the cell, then go back to the journal entries sheet and click on the number you want. Excel will automatically pull that number over. This way, your T accounts will stay linked to your journal entries, and any changes you make will update automatically. After posting everything to the T accounts, it's time to get the balance in our T account. So remember, the balance is the total debit minus the total credits for asset accounts. So we're going to take the total debits. So I'm just going to sum this here, and that adds up the whole column. It's just good practice to use the whole column, even though there are only 2 amounts in there, and minus the sum of the total credit column. So we have a balance in the cash account of $22,800. Just a quick heads up, when we're calculating the balance for an account that normally has a credit balance like common stock, we take the total of all the credits and subtract the total of all the debits. The result will show us the ending balance for that account. Now that we've balanced every account in our T accounts, the next step is to prepare a trial balance. This lets us double check that our total debits equal total credits. So we're ready to move on to adjusting entries and later closing. To build the trial balance, we simply transfer the ending balances from our T accounts into the trial balance sheet. Cash has a debit balance of $2,250. Office supplies has a debit balance of $2,400. Dividends has a debit balance of $2,000. Storage revenue has a credit balance of $2,000 balance of $9,800. Make sure you place this under the credit column. Salaries expense shows a debit balance of $2,000. Repairs expense is a debit of $950. Rent expense is a debit of $2,000. Telephone expense is a debit of $400. The other accounts like depreciation and insurance are zero for now, and that's fine. You can still list them with zero balances. Once all balances are entered, we add up the debit column and the credit column. Here's an Excel tip. Instead of retyping the formula, you can use Excel's autofill feature. After you enter the formula to sum the debit column, click on the little green corner in the bottom right of the cell and drag it across. Excel will automatically copy the formula to the credit column. Now we can see that debits equal credits, which means our trial balance is correct. With that confirmed, we're ready to move on to the adjusted trial balance, adjusting entries, closing entries, and finally preparing the financial statements. Now that we've completed our trial balance, the next step in the accounting cycle is adjusting entries. In our example, we have 5 adjustments to record. Let's go through them one by one. 1. Depreciation on building. We record a depreciation expense of $1,500. The credit goes to accumulated depreciation. Building. This is a contra asset account, meaning it reduces the related asset, in this case, the building account. 2. Prepaid insurance. We've used 2/3 of a month of our insurance. We debit insurance expense and credit prepaid insurance. The total insurance purchased was $7,200 for 12 months or $600 per month. 2/3 of 1 month is $400. So the adjustment is debit insurance expense $400, credit prepaid insurance $400. 3. Office supplies used. We started with $2,400 of supplies. At the end of the month, $1,525 remain. $2,400 minus $1,525 equals $875 used. So we record office supplies expense $875 and reduce office supplies $875. 4. Storage fees, earned but not yet billed. We earned $1,150 in storage fees that have not yet been billed to customers. Since we don't have the cash yet, we record it as accounts receivable. Debit accounts receivable, $1,150. Credit storage revenue, $1,150. Now we're going to take our adjusting entries and post them into the T accounts. Let's start with depreciation expense. On July 31st, we debit depreciation expense for $1,500. Then we post the credit to accumulated depreciation for the same amount. Remember, accumulated depreciation is a contra asset account, so it reduces the value of the building on the balance sheet. We'll follow this same process for each of the other adjustments. Post the debit side to the correct T account, then post the credit side to its corresponding account. Once all adjustments are posted, we recalculate the balances in each T account. This gives us the updated account balances, which we'll then use to prepare our adjusted trial balance. Next, we'll move to our trial balance sheet and update it with the new adjusted balances. We'll transfer the updated amounts for accounts receivable, office supplies, prepaid insurance, accumulated depreciation, buildings, salaries payable, storage revenue, salaries expense, depreciation expense, insurance expense, office supplies expense. Once all the adjusted balances are entered, we add up the debit column and the credit column. If our accounting is correct, the two totals will be equal. This step confirms that our adjusted accounts are balanced and ready for the next stage, preparing the financial statements. Before we prepare the final trial balance, we first need to calculate the adjusted trial balance. Here's how we do it. For assets, which normally have debit balances, we take the original debit amount, then add any debit adjustments and subtract any credit adjustments. That gives us the updated balance. For accounts like common stock and dividends, there were no changes this period, so their balances stay the same. For accounts with normal credit balances, like revenues or liabilities, we do the opposite. We take the original credit, add new credits, and subtract any debits. Expenses work the same way as assets. We start with the debit balance, add any new debits, and subtract any credits. As we go, we need to be careful to place each balance in the correct column. If something looks off, For example, if a debit is accidentally put under credits, then debits and credits won't match. Once we fix those, our adjusted trial balance will show equal debits and credits. That tells us we've recorded everything correctly, and we're ready to move on to preparing the financial statements. Next, we move to the financial statement sheet. Here we'll transfer all the values from the adjusted trial balance into the financial statements. We start with the income statement. First, we list storage revenue as our sales. Then we add up all the expenses, including salaries expense, depreciation expense, insurance expense, office supplies expense, repairs expense, rent expense, and telephone expense. To find net income, we subtract the total expenses from the revenue. After the income statement, we continue with the other financial statements, again pulling the numbers directly from the adjusted trial balance. Finally, when preparing the balance sheet, we must double check that total assets equals total liabilities plus equity. If they match, our financial statements are complete and correct. Now, the last step in our accounting cycle is to close the books. Step 1, close revenues. We start with storage revenue, which has a normal credit balance. To bring it to zero, we debit storage revenue for $10,950 and credit income summary for the same amount. This transfers the revenue balance into income summary. Step 2, close expenses. Next, we close all of our expense accounts: salaries expense, insurance expense, rent expense, and others. To do this, we debit income summary for the total of all expenses, $8,225, and credit each individual expense account. Now, all expense accounts show zero balances, and the total has been transferred to income summary. Step 3, close dividends. After expenses, we close dividends. Dividends had a $2,000 debit balance. To clear it, we debit income summary and credit dividends for $2,000. Step 4, close income summary. Finally, we close the income summary account. At this stage, income summary shows the difference between total revenues and total expenses and dividends. In this case, the balance is $725. We debit income summary for $725 and credit retained earnings for $725. Now all temporary accounts, revenues, expenses, and dividends have zero balances. The net result has been transferred into retained earnings. Final check. To confirm, our closing trial balance should only include permanent accounts, assets, liabilities, and equity. Debits should equal credits. And the retained earnings balance should match the amount shown on the statement of retained earnings. And with that, we have completed the entire accounting cycle.